Hi everyone, welcome back to my channel Finance with Maqsudur Rahman. So today the topic is DCF valuation, discounted cash flow valuation. So DCF valuation is a powerful tool which analysts and investors use to value a company. So let me get the definition first. So DCF is a valuation method which is used to estimate the value of an investment based on its expected future cash flows. DCF analysis attempts to figure out the value of an investment today based on projections of how much money it will generate in the future. It doesn't make sense, is it? Okay, let me let me describe it in a broader way. So here you can see there are some cash flows of here are the CF. These are the cash flows, and this is the terminal year cash flow. So what DCF would do, DCF would discount this cash flows of actually the forecasted cash flows of the company and discount it to the present day, and then it will give us a total value, which would be the value of business. And after getting the value we will get if after getting the value we will simply divide the value, total value, with the number of outstanding share, and which will give us the price of individual share. And we can make comparative analysis of the share price. The share price will be getting with the actual market price, and we're going to analyze, is the value of the company or the share is undervalued or overvalued, or is it selling on discount or at premium. So this is the purpose of DCF, to make the comparative analysis of a company value with its share price. So in this section, basically in this lecture, what I'm going to explain is that how to get the DCF value from the cash flow, and how to get the price of a share from this discounted cash flows, and make our analysis. So I'm going to show you the Excel file, and I'm going to show you the method how to get the Excel file. So let's not wait and move down to our Excel. So here is my Excel file, and you can see here is the balance sheet of Apple. I've already shown in my previous video that how I have downloaded the data from a US government website. From here I'm just taking the EBIT to get my cash flow. So here simply put the EBIT in the first row, and you can see the September 24 is our actual one, and from September 25 to September 29 is our forecasted one. So I'm going to simply put the tax rate under the EBIT. The tax rate is 30% for the US government and use US jurisdiction. So after deducting the tax from the EBIT, we will simply get the after tax EBIT, the after tax cash flow. And then we're going to take the growth rate, reinvestment rate. So here you can see the reinvestment rate for the telecom service is 20.12%, and you can get your reinvestment rate by doing your analysis, but I thought to get the reinvestment rate from the industry because it would be much more easier and much more practical. And then I have to deduct the reinvestment rate from the actual after tax EBIT. Simply the formula would be multiplying the 1 minus the reinvestment rate. So you can see we got our after reinvesting we got this cash flow, and then we would be having the discounting factor and our present value of DCF. But beforehand we need to get the we have to get the expected growth rate and the weighted average cost of capital and the other segment as well. So the growth rate we can see for this sector is 2.37%. So we'll simply put 2.37%. So we'll simply multiply the growth rate with our 2024 cash EBIT to get our forecasted EBIT for the year 2025, and we have to log the cell as well, so it would be remain same, the growth rate for all those years onwards. Simply drag it and get a result. Here you go. And for the after tax EBIT, same thing we have done, and for the after reinvesting the EBIT or the cash flow. For the terminal growth, we can take the GDP, and we have taken the weighted average cost of capital from a website, Guru Focus, and we have compared it with the other website and the sources as well. What would be the weighted average cost of capital for the Apple? So I'm just showing you how to do the model. So you can calculate all of this, the weighted average cost of capital by yourself as well. And here we are getting the year count after like 0.5 and 1.5, 3.5, 4.5 and 5.5 for the forecasted years, because this is one of the conventional method to take the 0.5 to get you discount rate, because not all the cash has been collected by the end of year, and this is the theory behind to use 0.5 and then 1.5 as a discounting factor year. So the discounted factor would be simply 1 divided by the 1 plus the weighted average cost of capital, and it would be powered by the segment of the year, whatever the year it is. So 0.5 would be our next year 2025, and 1.5 for the 2026 and onwards. It would be adding another year, and here we have got our discount factor. So I've just labeled it green, so it would be easier to analyze what are the year that I'm going to forecast for my DCF model, and the blue one is the actual one, is for the September 2024. So I have to get the terminal FCF and the terminal value of the company as well. Before that I need to get the GDP 3.1%. So we are assuming that company is going to grow with the GDP of the US government. So this is one of the good benchmark to take as the terminal growth, and it has been done by different renowned analysts, so we can use this method to get our terminal growth. Just need to lock the cell. That's why it's not giving us the actual result. So the terminal value, the discounted value, we have to multiply with the growth rate 1 plus the growth rate to get the actual terminal value for the next year onwards, 2029. And weighted average cost, simply copied it, and the terminal growth rate, simply the GDP, and then we are going to calculate the terminal value. I've already explained all of them on my Microsoft slide at the beginning of the video, that we have to get the terminal value, the present value of the terminal value, and the cash flow present value as well. So this give us so the present value of the FCFF would be the sum of the all the present value we got, and then the present value of terminal value we have got in our previous table. We just simply put it, and then finally the enterprise value would be the sum of these two values. Here you go, we can see 924,054 million for the Apple Company Limited. And then what we need to do, we need to add the cash and less the debt. So simply add the cash or cash equivalent, which is 29943 for the year 2024, and we have to just get rid of the debt, less the debt from the enterprise value to get our actual enterprise value. So it would be the short term and the long term debt of the company. So these are the short term, and the long term would be this. It would be easy if you always have the balance sheet next to your DCF valuation, so you'll easily get the number all the time, not jump on the another sheet, another Excel file. I think I may give me a moment. I think something wrong. Hmm, I think I have accidentally taken the total current debt. Okay, I'll get this sorted out later on. Let me get the number of share first. Okay, so the number of share would be 1517190, and I have to divide it with a million because everything defined on the balance sheet would be is in million. So I have to divide it by the million to get the million number of share and do my analysis. So equity value per share 31. Okay. Oh, I think I forgot to do my correction for the short-term debt, which is subtracted. So previously I've taken the short-term debt, the total short-term debt, which I need to subtract. So let me do this formula again. So is equal to sum, and then jump on the balance sheet, take the short-term debt apart from the give me a moment. Yeah, these two and these two. Last time I've taken the total short-term debt. I think in that part I've done my done a mistake. So just doing it right now. And the total long-term debt. Yeah. So now it is showing us 43.120. So the market price of the apple is 250. So if we divide 250 by the price we got, we can see it is 5.8 times than the actual value in the market. So what we have got till now is that Apple share on the market is overpriced than its actual value. And before I make my final statement, let me sort out the data first. Make the graph and the table much more beautiful. So this is like kind of like, professionalism. So if you are professional and you have to submit a report, you have to make the graph a bit more beautiful and make it much more organized. Mhm. Just make it green and So the green part is the forecasted one, as I've mentioned it before. And what more we can do? Let's see. So one of the reason I didn't deduct the amortization or the depreciation, because this is a tech company and it doesn't show any depreciation or amortization on the balance sheet, and I have used the operating income as EBIT, and I think this is one of the way to do it, to deal with this tech company Apple. And um, so um, so I think we are quite at the end of our lecture, and so DCF has been widely used to just to compare its price with its market price, whether the share is trading at premium or at discount, and it also has been widely used for the mergers and acquisition. And I'm extremely sorry while I'm editing and while I'm talking, because I'm doing two things simultaneously. So this is the main purpose of DCF: to value a company, to do mergers and acquisition, or to see if the share is trading at a discount price or at a premium, and make the investment decision for the investor, or for the analyst for himself as well. So I think this is it. See you with another video very soon. Goodbye.